I need to tell you something that might upset a lot of financial advisors. For the past 40 years, there has been one investing rule that almost everyone has followed. It has been the foundation of retirement planning. It has been taught in every finance textbook. It has been recommended by virtually every financial advisor in America. And for most of that time, it worked beautifully. But here is the uncomfortable truth. That rule no longer works. The world has changed. The markets have changed. The economic environment has changed. And if you are still following this 40-year-old rule, you are putting your retirement at serious risk. I have been investing for over 70 years now. I have seen markets transform multiple times. I have watched strategies that worked brilliantly for decades suddenly stop working. And I have learned that the most dangerous thing an investor can do is assume that what worked in the past will automatically work in the future. The world does not stand still. The rules of the game change. And the investors who refuse to adapt are the ones who get hurt. Today, I am going to explain exactly what this rule is, why it worked so well for 40 years, and most importantly, why it has stopped working. I am also going to share what I believe you should do instead, because understanding this shift is not just academic. For anyone approaching retirement or already retired, this is essential knowledge that could determine whether you have a comfortable retirement or whether you run out of money. Let me start by telling you what rule I am talking about. It is the 60-40 portfolio, 60% stocks, 40% bonds. This allocation has been the gold standard of retirement investing since the 1980s. The idea is simple. Stocks provide growth, bonds provide stability and income. When stocks go down, bonds usually go up, providing a cushion. The combination gives you reasonable returns with manageable risk. For 40 years, this worked exactly as promised. I remember when this strategy first became popular. It was the early 1980s. Interest rates had just peaked at historic highs. Paul Volcker at the Federal Reserve had raised rates to nearly 20% to fight inflation. Bond yields were extraordinary. You could buy a 30-year Treasury bond yielding 15% or more. Think about that. 15% guaranteed by the United States government. And what happened next was one of the greatest bull markets in bond history. As inflation came down and interest rates fell over the following decades, bond prices rose dramatically. Someone who bought those high-yielding bonds in 1981 not only collected enormous interest payments, but also saw significant capital appreciation as rates declined. At the same time, the stock market was entering its own historic bull run. From 1982 to 2000, the S&P 500 delivered some of the best returns in market history. And even with the dot-com crash and the 2008 financial crisis, stocks continued their long-term upward trajectory. The combination of falling interest rates, boosting bond returns, and a strong stock market meant that the 60-40 portfolio delivered remarkable results. From 1980 to 2020, a 60-40 portfolio averaged returns of around 9 to 10% annually with relatively low volatility. Retirees could withdraw 4% per year and have high confidence their money would last 30 years or more. The strategy just worked. But here is what people missed. The success of the 60-40 portfolio was not due to some magical property of that specific allocation. It was due to a very specific set of economic conditions that existed during that 40-year period. Falling interest rates from historic highs, declining inflation, strong economic growth, globalization reducing costs, demographics that supported growth. These conditions created a perfect environment for both stocks and bonds to thrive. And those conditions no longer exist. Let me explain what has changed. First, and most importantly, interest rates hit zero. You cannot fall from zero. From 1980 to 2020, bond investors benefited from a 4-decade decline in interest rates. 10-year Treasury yields went from over 15% to under 1% at their lowest point. That is an extraordinary tailwind for bond prices. But that tailwind is gone. Interest rates cannot go meaningfully negative. There is no more room to fall. The 40-year bond bull market is over. Second, we have entered a new inflationary environment. For most of the past 40 years, inflation was tame. It averaged around 2 to 3%. Central banks had it under control. That allowed them to keep interest rates low and provided a stable environment for both stocks and bonds. But since 2021, inflation has surged. We saw inflation hit 9% in 2022, the highest in 40 years. And while it has come down some, we are likely entering a period of structurally higher inflation than we experienced in the 2010s. Why? Massive government deficits, deglobalization, labor shortages, energy transitions. All of these create inflationary pressures that did not exist in the previous 4 decades. Third, and this is crucial, the correlation between stocks and bonds has changed. The whole point of the 60-40 portfolio was diversification. When stocks went down, bonds were supposed to go up, cushioning your losses. This worked beautifully from the mid-1990s until recently because inflation was low and stable. When stocks fell, it was usually due to growth concerns, and the Federal Reserve would cut interest rates to stimulate the economy, causing bond prices to rise. But in an inflationary environment, this relationship breaks down. In 2022, we saw both stocks and bonds fall simultaneously. The S&P 500 was down about 18%. Long-term Treasury bonds were down over 30%. The 60-40 portfolio had one of its worst years in history, down around 17%. This was not supposed to happen. Bonds were supposed to protect you, but they did not because inflation changed the rules. Let me explain why this correlation shift is so devastating. The mathematical foundation of the 60-40 portfolio depends on stocks and bonds being negatively correlated or at least uncorrelated. That is what provides the diversification benefit. But when stocks and bonds move together, when they both go down at the same time, you lose that benefit entirely. You get all the downside risk of holding both asset classes with none of the diversification benefit. This is exactly what happened in 2022, and it is exactly what will happen again in future inflationary periods. Now, some people will say that 2022 was an anomaly, that things will return to normal, that the old correlations will reassert themselves. I am not so sure. If we are entering a period of structurally higher inflation, higher interest rates, and greater fiscal uncertainty, the conditions that made the 60-40 portfolio work may not return for a very long time. And if you are retired or approaching retirement, you do not have time to wait and see. You need a strategy that works in the current environment, not one that worked in an environment that may no longer exist. Let me share a historical perspective that might surprise you. Before the 1980s, the 60-40 portfolio did not work well at all. During the 1970s, high inflation devastated both stocks and bonds. A 60-40 portfolio lost significant purchasing power over that decade. During the 1960s, bonds delivered poor returns as interest rates rose. The 60-40 allocation is not some timeless truth. It is a strategy that happened to work extremely well during a very specific 40-year period. And that period may be over. I want to be clear about something. I am not saying stocks and bonds are bad investments. I am not saying you should abandon diversification. What I am saying is that the simple 60-40 allocation applied mechanically without regard to current conditions is a flawed approach. The conditions that made it work have fundamentally changed. Continuing to follow it blindly could seriously damage your retirement. So what should you do instead? Let me share my thinking on this, understanding that everyone's situation is different. First, you need to think differently about bonds. In the old regime, bonds served two purposes. They provided income and they provided protection when stocks fell. In the new regime, bonds still provide income, but you cannot count on them to protect you when stocks decline. Inflation changes the math completely. When inflation is the primary risk, bonds can lose value at the same time as stocks, providing no cushion at all. This does not mean you should avoid bonds entirely. It means you need to be more thoughtful about which bonds you own and why you own them. If you are holding bonds for income, short duration bonds make more sense than long duration bonds. Short duration bonds are less sensitive to interest rate changes. They will not give you capital gains if rates fall, but they also will not crush you if rates rise unexpectedly, and they still provide a yield. In the current environment, short-term treasuries are yielding 4 to 5%. That is actual income without taking significant interest rate risk. I would avoid long-duration bonds entirely right now. The risk-reward is terrible. If interest rates rise further, long-duration bonds will get crushed. If rates fall modestly, you might get some capital gains, but those gains are limited because rates are already much higher than they were a few years ago. The asymmetry is unfavorable. You are taking a lot of risk for limited potential reward. Second, you need to think about inflation protection. In the old regime where inflation was 2% and stable, you did not need to worry much about inflation eating away at your purchasing power. In the new regime, inflation is a real threat. You need assets that can maintain their value when inflation rises. What protects against inflation? Real assets, businesses with pricing power, commodities, real estate. These are assets that tend to rise in value when inflation rises because their underlying value is tied to real economic activity, not to nominal dollar amounts. A barrel of oil is a barrel of oil regardless of what is happening to the dollar. A great business can raise prices to offset higher costs. These assets provide natural inflation protection that bonds cannot provide. Stocks, particularly stocks of companies with strong pricing power and durable competitive advantages, can actually be decent inflation hedges over the long term. If a company like Coca-Cola or Apple or a great consumer products company can raise prices to offset inflation, their earnings and stock prices tend to keep pace with or exceed inflation over time. This is very different from bonds, where you are locked into fixed nominal payments that lose purchasing power as inflation rises. Third, you need to think more dynamically about asset allocation. The 60-40 rule was appealing because it was simple. You set it and forget it. Rebalance once a year and do not think about it. But simple rules only work in stable environments. In a changing environment, you need to adapt. This does not mean you should become a market timer, jumping in and out of stocks based on your predictions. Market timing rarely works and usually leads to poor results. What it means is that your allocation should reflect current valuations and current conditions, not some arbitrary rule set 40 years ago. Let me give you an example. Right now, as I think about where we are in late 2025, short-term Treasury bills are yielding around 4.5% to 5%. That is a real return. You can sit in short-term Treasuries and earn 5% with virtually no risk. Compare that to the stock market, which is trading at relatively high valuations. The earnings yield on the S&P 500, which is the inverse of the price-to-earnings ratio, is around 4 to 5%. So stocks, which are risky, are yielding about the same as risk-free short-term Treasuries. In that environment, holding more cash or short-term bonds makes sense. You are not giving up much potential return, and you are reducing risk significantly. This is very different from the 2010s, when Treasury bills were yielding close to zero. In that environment, holding cash was extremely costly because you were earning nothing while stocks were going up. The opportunity cost was enormous. Today, the opportunity cost of holding cash is much lower. Fourth, you need to own more productive assets. This is something I have believed my entire investing career, but it becomes even more important in an inflationary environment. You want to own pieces of businesses that can grow their earnings over time, that have competitive advantages, that protect them from competition, that can raise prices when costs go up. These businesses create real wealth. They do not just preserve nominal values. They actually increase your purchasing power over time. Think about a wonderful business like Apple or American Express or Coca-Cola. These companies have incredible competitive positions. They have loyal customers who will keep buying their products regardless of what happens to inflation or interest rates. When costs go up, they can raise prices. When the economy grows, they grow with it. Owning pieces of businesses like these is the best long-term protection against inflation and the best way to build real wealth. I have always said that stocks are not pieces of paper that bounce around in price. They are ownership stakes in real businesses. When you think about them that way, you realize that owning great businesses is fundamentally different from owning bonds or gold or other assets that do not create anything. Great businesses are wealth-creating machines. They compound value over time, and that compounding is what builds lasting wealth. Fifth, be extremely careful about withdrawal rates. The 4% rule, which says you can withdraw 4% of your portfolio each year in retirement and be confident your money will last, was developed based on historical data that includes the 40-year period when the 60-40 portfolio worked beautifully. If future returns are lower than historical returns, which I believe is quite possible given current valuations and economic conditions, the 4% rule may be too aggressive. This is not a popular thing to say. People want to believe they can spend freely in retirement. But math is math. If your portfolio returns 6% instead of 9% and you withdraw 4%, your cushion is much smaller. You have less margin for error. Bad sequence of returns early in retirement, where the market drops significantly in your first few years, can devastate your portfolio. I am not saying everyone needs to cut their spending dramatically. What I am saying is that you need to be realistic about expected returns and have a plan that works even if returns disappoint. Building in flexibility to reduce withdrawals during bad markets, having multiple income streams, delaying Social Security to get a higher guaranteed benefit, these are all ways to reduce the risk of running out of money. Let me share something else that I think is important. The investing environment we are in now is fundamentally more challenging than the environment of the past 40 years. Interest rates went from high to low. Now they are unlikely to fall much further and could rise. Inflation went from high to low. Now it is back and could remain elevated. Corporate profit margins expanded dramatically due to globalization and technology. Those tailwinds are diminishing. Government debt has exploded, which creates risks we have not had to deal with for a long time. This does not mean you cannot make money investing. It does not mean you should hide under a rock, but it does mean you should be more careful, more thoughtful, more realistic about potential returns, and more focused on avoiding big mistakes. In a more challenging environment, not losing money becomes even more important than making money. I have always believed that rule number one of investing is do not lose money, and rule number two is do not forget rule number one. That was true in the easy environment of the past 40 years. It is even more true in the challenging environment ahead. Now, let me address some objections that people might have to what I am saying. Some people will say that I am being too pessimistic, that the 60-40 portfolio has worked for decades and will continue to work, that I am overthinking things. To those people, I would say, look at the data. 2022 showed exactly what happens to a 60-40 portfolio in an inflationary environment. Both asset classes lost money. The portfolio lost 17%. If you are retired and drawing income from your portfolio, a 17% loss plus withdrawals can permanently impair your standard of living. This is not theoretical. It happened, and it could happen again. Some people will say that I am recommending market timing, which does not work. I want to be very clear that I am not recommending market timing in the traditional sense of trying to predict when the market will go up or down. What I am recommending is being thoughtful about asset allocation based on current conditions. There is a difference between timing the market, which means trying to predict short-term movements, and adjusting your allocation based on valuations in the investment environment. One is speculation. The other is prudent risk management. Some people will say that individual investors cannot beat a simple 60-40 portfolio, so they should just stick with it. There is some truth to the idea that simplicity helps most investors avoid costly mistakes, but simplicity should not trump common sense. If conditions have changed fundamentally, sticking with an outdated approach is not wisdom, it is stubbornness. And stubbornness can be very expensive. Some people will say that stocks always beat bonds over the long term, so why not just own more stocks? This is true historically, but it ignores the importance of time horizon and sequence of returns. If you are 30 years old with 40 years until retirement, you can probably ride out any downturn. But if you are 65 and about to retire, a 50% drop in the stock market could devastate your retirement plans. You do not have time to recover. Asset allocation is not just about maximizing long-term returns. It is about Matching your investments to your time horizon and your need for certainty. Let me talk about what I actually do and what I recommend for most people. For most investors, I still believe that owning a diversified portfolio of low-cost index funds is the best approach. A broad stock market index fund that owns hundreds or thousands of companies provides diversification, low costs, and exposure to the growth of the overall economy. Over long periods, this approach will serve most people well. But I would modify the traditional 60-40 allocation in several ways given current conditions. First, I would reduce exposure to long-duration bonds significantly. The risk-reward is unfavorable. Short-duration bonds or treasury bills provide income without the interest rate risk. Second, I would make sure my stock holdings emphasize companies with strong competitive positions and pricing power. These companies can maintain profitability even in inflationary environments. Third, I would hold more cash than the traditional allocation suggests. Cash is not earning zero anymore. It is earning 5%. That changes the math considerably. Fourth, I would think carefully about international diversification. The U.S. market is trading at premium valuations. Some international markets offer better value. For more sophisticated investors who can handle individual securities, I think owning a concentrated portfolio of truly excellent businesses is the best approach. Great businesses with durable competitive advantages are the best inflation hedge and the best long-term wealth creators. But this requires skill and knowledge that most investors do not have. If you cannot analyze businesses deeply, stick with index funds. One more thing I want to emphasize. Whatever strategy you choose, costs matter enormously. Every dollar you pay in fees is a dollar you do not compound. Over decades, high fees can consume a shocking percentage of your wealth. Index funds and ETFs with expense ratios of 0.03% or less are widely available. There is no reason to pay 1% or more to an actively managed fund that will probably underperform the index anyway. This is true regardless of what asset allocation you choose. Keep costs low. Let me also say a few words about advisors. Many financial advisors still recommend the 60-40 portfolio because it is simple, it is easy to explain, and it has worked historically. Some advisors may not fully understand how conditions have changed. Others may understand but find it easier to stick with the familiar approach. If your advisor is still recommending a standard 60-40 allocation without acknowledging the changes in the investment environment, you might want to have a conversation about their thinking. A good advisor should be able to explain why they believe the approach still makes sense or how they are modifying it for current conditions. I want to close by bringing this back to first principles. The goal of investing for retirement is not to follow rules or beat benchmarks. The goal is to have enough money to live comfortably for the rest of your life without running out. That goal is what should drive all your decisions. The 60-40 rule was never the goal. It was a tool that happened to work well for achieving the goal during a specific period. Now that the environment has changed, we need to adapt the tool or find new tools that work better in current conditions. This is not a reason to panic or to make dramatic changes to your portfolio overnight. Dramatic changes usually lead to mistakes, but it is a reason to think carefully about whether your current approach makes sense given where we are today. It is a reason to stress test your retirement plan against scenarios where both stocks and bonds struggle. It is a reason to build in more cushion and flexibility. Investing is always about dealing with uncertainty. Nobody knows for sure what will happen over the next 10 or 20 or 30 years. What we can do is think clearly about the range of possibilities and position ourselves to survive and thrive across that range. The 60-40 portfolio worked when conditions were favorable. It struggled when conditions changed. A better approach is one that can adapt to changing conditions and does not rely on any single set of assumptions. I have been investing for over 70 years. I have seen markets change many times. I have watched strategies that worked beautifully stop working. I have seen investors who refuse to adapt suffer serious consequences. And I have learned that flexibility, humility, and willingness to change your mind when facts change are essential qualities for long-term success. The 40-year-old rule was a good rule for its time, but times have changed. The investors who recognize this and adapt will do better than those who cling to the past. That has always been true in investing. It is especially true today. Be thoughtful, be flexible, be realistic about the challenges ahead, and remember that the goal is not to follow rules. The goal is to secure your financial future. Keep that goal firmly in mind and let it guide your decisions. Everything else is just noise. The old rules served us well for 40 years. Now it is time for a new approach that is better suited to the world we actually live in. Do not let nostalgia for what worked in the past blind you to what is needed for the future. Your retirement depends on it. One thing I learned long ago is that the past is useful for learning principles, but it is dangerous for making predictions. Just because something worked for 40 years does not mean it will work for the next 40 years. The conditions that drove that success matter more than the success itself. And when those conditions change, the outcomes change too. I think we are at one of those inflection points now. The conditions that made the 60/40 portfolio so successful, falling interest rates, declining inflation, strong economic growth, are unlikely to repeat in the coming decades. At best, we are looking at a period of higher inflation, higher interest rates, and lower returns than investors have gotten used to. At worst, we could face serious fiscal and economic challenges that make the past 40 years look like an anomaly. In that environment, the old rules need to be re-examined, the strategies that work need to be stress tested against new scenarios, and investors need to be prepared for a world that may look very different from the one they have known. This is not meant to frighten you. Markets have always had challenges and uncertainties. Investors have always had to navigate difficult environments. What matters is being prepared, being realistic, and being adaptable. Those qualities will serve you well regardless of what happens. So take a hard look at your portfolio. Ask yourself whether your current allocation makes sense given where we are today, not where we were 10 or 20 years ago. Consider whether you have too much exposure to long-duration bonds that could suffer in an inflationary environment. Think about whether your stock holdings are concentrated in quality businesses that can thrive even when times are tough. Make sure you have enough liquidity to weather market downturns without being forced to sell at bad prices. And most importantly, have a plan that works even if things do not go perfectly. Because in investing, things rarely go perfectly. The investors who succeed are not the ones who predict the future correctly. They are the ones who survive the surprises. Build a portfolio and a plan that can survive the surprises, and you will be well positioned regardless of what the next 40 years bring. The 40-year-old rule had its day. Now it is time to move on. The investors who adapt will prosper. The investors who cling to the past will struggle. I know which group I want to be in, and I suspect you do too. Think carefully about what I have said. Look at your own situation with clear eyes and make the changes that need to be made. Your future self will thank you for having the wisdom and courage to adapt when the rules of the game changed. That is what great investors do. They recognize when the game has changed and they adjust accordingly. They do not fight the last war. They prepare for the next one. The 60/40 rule was perfect for the war we just fought. But a new war is coming. Make sure you are ready for it. The bond market that made the 60/40 portfolio shine has fundamentally changed. The inflation environment that kept bonds safe has fundamentally changed. The correlation between stocks and bonds that provided diversification has fundamentally changed. When everything that made a strategy work has changed, continuing to follow that strategy blindly is not discipline, it is denial. And denial in investing leads to losses that could have been avoided. Be honest with yourself about the environment we are in. Be willing to challenge the conventional wisdom that everyone follows. Be prepared to think independently and act accordingly. That is what successful investing has always required. And it is what it requires now more than ever. The 40-year-old rule served its purpose. Now it is time for a new chapter. Make sure your portfolio is ready to turn the page. But before I leave you, let me go even deeper into some of the specific changes I think investors need to make. Because understanding the problem is one thing. Knowing exactly what to do about it is another. Let me talk about Treasury inflation-protected securities, commonly called TIPS. These are bonds that adjust their principal value based on inflation. When inflation goes up, the principal increases, and so do your interest payments. When inflation goes down, the principal decreases. In theory, TIPS should provide protection against inflation because they are specifically designed to do so. However, there are some important caveats. First, TIPS protect against measured inflation, which is the Consumer Price Index. But your personal inflation rate may be different from CPI. If you spend a lot on healthcare or education or housing, your costs may be rising faster than the official inflation rate. Second, TIPS can have negative real yields, meaning you are actually losing purchasing power even after the inflation adjustment. This happened during the early 2020s when TIPS yields went significantly negative. You were guaranteed to lose purchasing power by holding them. Third, TIPS are still bonds and still have duration risk. If real interest rates rise, TIPS prices fall, just like regular bonds. So they are not a free lunch. That said, in the right circumstances, TIPS can be a useful part of a portfolio. If you are concerned about unexpected inflation, TIPS provide a hedge that regular bonds do not. Just understand their limitations and do not rely on them as your only inflation protection. Let me also discuss real estate. Real estate has historically been a decent inflation hedge because property values and rents tend to rise with inflation over time. If you own your home, inflation is actually somewhat beneficial because your mortgage payments stay fixed while your home value and wages presumably rise with inflation. Your real cost of housing effectively declines over time. But real estate as an investment is more complicated. Residential real estate requires management, maintenance, and dealing with tenants. Commercial real estate is facing structural challenges from remote work and e-commerce. Real estate investment trusts, known as REITs, provide a way to own real estate without direct ownership, but they come with their own risks. REITs tend to be sensitive to interest rates, so they can struggle in rising rate environments even if underlying property values are holding up. I am not against real estate as part of a diversified portfolio, but I would be careful about overweighting it as an inflation hedge, and it is not as simple as people think. And the current environment with high interest rates and changing work patterns creates specific challenges for many types of real estate. What about gold and commodities? I have never been a fan of gold. It does not produce anything, it just sits there. You buy it hoping someone else will pay more for it later. That is not investing, that is speculation. Yes, gold has held its value over very long periods. An ounce of gold could buy a nice suit 2,000 years ago and can buy a nice suit today. But it has not created any wealth in that time. It has not compounded, it has not grown, it has just maintained. Compare that to a great business that grows its earnings every year, that reinvests those earnings to grow even more, that compounds value decade after decade. Over any meaningful time period, great businesses vastly outperform gold. Gold might protect you from a complete collapse of the financial system, but that is a very extreme scenario. And even in that scenario, I am not sure gold would help as much as people think. If society collapses, you probably want food and tools and skills, not gold bars. Commodities more broadly can provide some inflation protection because they are real goods whose prices tend to rise with inflation. But commodities are extremely volatile and do not produce any income. They are also subject to supply and demand dynamics that can overwhelm inflationary pressures. I would not recommend commodities as a significant part of most portfolios. They are speculative instruments better suited for professionals. Let me spend more time talking about what I consider the best inflation protection, which is owning great businesses. When I say great businesses, I mean businesses with certain specific characteristics. First, they have pricing power. They can raise prices when their costs go up without losing customers. This is the most important characteristic for inflation protection. A business that cannot raise prices will see its profit margins squeezed when inflation hits. A business that can raise prices will maintain or even expand margins. What gives a business pricing power? Usually it is some combination of a strong brand, customer loyalty, high switching costs, or a product that customers cannot easily substitute. Think about a product like Coca-Cola. If Coca-Cola raises prices by 10%, most customers will not switch to a generic cola. They want Coca-Cola specifically. That is pricing power. Or think about software that companies have built their operations around. If that software vendor raises prices, the company cannot easily switch because their whole workflow depends on that software. That is pricing power from switching costs. Second, great businesses have low capital requirements relative to their earnings. They do not need to constantly invest in expensive equipment or facilities that cost more during inflation. An asset-light business can return most of its earnings to shareholders or reinvest them in growth. An asset-heavy business has to plow earnings back into maintaining its capital base, and that capital base costs more during inflation. Think about the difference between a software company and a steel company. The software company creates its product once and can sell it millions of times with minimal additional cost. It does not need factories or expensive equipment. The steel company needs blast furnaces, rolling mills, transportation equipment. All of that costs more during inflation. So even if both companies can raise prices equally, the software company will generate more free cash flow relative to its earnings. Third, great businesses have durable competitive advantages that will persist over time. It is not enough to have pricing power today. You need to have confidence that the business will still have pricing power in 10 or 20 years. That requires analyzing the competitive dynamics of the industry, the strength of the brand, the nature of the customer relationship, the barriers to entry for competitors. Some businesses have advantages that erode over time as technology or customer preferences change. Other businesses have advantages that compound over time as they get stronger with scale. You want to own the second type. Fourth, great businesses are run by competent and honest management teams. Management quality is easy to overlook when things are going well, but it becomes critical when things get difficult. Good managers allocate capital wisely, maintain competitive advantages, and position the business for long-term success. Bad managers squander resources, make poor acquisitions, and fail to adapt to changing conditions. I spend a lot of time evaluating management when I invest. I look at their track record, their capital allocation decisions, their compensation structures, their communications with shareholders. A great business run by mediocre management will eventually become a mediocre business. A mediocre business run by great management can become a great business, but it is harder when you own a portfolio of businesses with these characteristics. You have built-in inflation protection without needing to own gold or tips or complicated hedging instruments. The businesses themselves adapt to inflation through their pricing power and efficient capital usage. That is far better than owning assets that just try to keep pace with inflation. Now, let me address something that I think is particularly important for people approaching retirement or already in retirement. Sequence of returns risk is one of the biggest threats to retirement security, and it becomes even more dangerous in the current environment. Sequence of returns risk refers to the timing of market returns relative to when you are making withdrawals. If you experience bad returns early in retirement when your portfolio is largest and you are making withdrawals, it can permanently impair your portfolio even if returns are good later. The math is brutal. If your portfolio drops 50% and you continue withdrawing, you have far fewer assets to benefit from the eventual recovery. You can end up running out of money even if the long-term average returns are good, just because the timing was bad. In the old environment where bonds provided a stable cushion, sequence risk was more manageable. If stocks dropped, your bonds would likely hold up or even rise, limiting your overall losses. But in an environment where stocks and bonds can both drop simultaneously, the potential for large early losses increases. This makes sequence risk more dangerous. How do you protect against sequence risk? Several ways. First, maintain more liquidity than traditional advice suggests. Having 1 to 2 years of expenses in cash or very short-term bonds means you do not have to sell stocks during a downturn. You can wait for recovery while living on your cash cushion. Yes, holding more cash means lower expected returns, but it also means lower sequence risk, which can be more important than maximizing returns. Second, consider delaying Social Security if you can afford to. Every year you delay Social Security from age 62 to age 70, your benefit increases by 6 to 8%. That is a guaranteed return with no market risk. For many people, delaying Social Security is one of the best financial decisions they can make. It provides a larger guaranteed income stream that you cannot outlive, reducing the pressure on your portfolio. Third, be flexible with your spending. The 4% rule assumes constant withdrawals regardless of market conditions. A more sustainable approach is to reduce spending during market downturns and increase it during good times. This dynamic approach dramatically reduces the risk of running out of money. It requires flexibility and some sacrifice during bad years, but it provides much greater security over the long term. Fourth, maintain some growth assets even in retirement. This seems counterintuitive because growth assets are more volatile, but for most retirees, retirement will last 25 or 30 years. That is a long time horizon. You need some growth to outpace inflation and maintain purchasing power. A portfolio that is too conservative may avoid short-term volatility but lose purchasing power over time. The key is having enough safe assets to weather short-term storms while maintaining enough growth assets for long-term purchasing power. Let me also talk about the role of dividends in the current environment. Dividend-paying stocks have historically provided a combination of income and growth that is attractive for retirees. The dividend provides current income, while the stock price appreciation provides growth, and companies that have consistently raised dividends over time have demonstrated discipline and financial strength. In the current environment, where bond yields are higher than they have been, dividends have some competition for income investors. But dividends have an important advantage over bond coupons. They can grow over time. A bond pays a fixed coupon that loses purchasing power to inflation. A dividend from a great company typically grows faster than inflation, increasing your purchasing power over time. I like dividend-paying stocks, particularly from companies with long track records of dividend growth. These tend to be mature, stable businesses with strong competitive positions. They may not offer the growth potential of younger, faster-growing companies, but they provide a combination of income and stability that is valuable in retirement. However, I would caution against chasing high dividend yields without considering the underlying business quality. Some stocks have high yields because the market expects the dividend to be cut. Those are traps, not bargains. Focus on dividend sustainability and growth potential, not just current yield. Let me bring this back to the big picture. The core message I want you to take away is that the investment environment has changed fundamentally, and your approach needs to change with it. The 60-40 rule was appropriate for a specific set of conditions that existed from 1980 to 2020. Those conditions no longer exist. Continuing to follow the rule as if nothing has changed is dangerous. What should replace the 60-40 rule? I do not think there is one simple rule that works for everyone. Your allocation should depend on your age, your risk tolerance, your income needs, your other sources of income like Social Security and pensions, your health, your family situation. Cookie-cutter advice does not work. But here are some principles that I believe apply broadly. Own high-quality businesses with pricing power and strong competitive positions. They are the best long-term investments and the best inflation protection. Avoid long-duration bonds in an inflationary environment. They provide little yield and significant risk. Hold more short-term bonds and cash than traditional advice suggests. Cash is earning real returns now and provides valuable flexibility. Be realistic about expected returns. The next decade is unlikely to match the returns of the past 4 decades. Plan accordingly. Focus on not losing money. In a more challenging environment, avoiding big losses is more important than maximizing gains. Keep costs low. Every dollar you pay in fees is a dollar you are not compounding. Stay flexible and adapt as conditions change. The investors who thrive are the ones who adjust when the rules of the game change. I have lived through many market environments over my career. Bull markets and bear markets, inflation and deflation, booms and busts. Through all of it, certain principles have remained constant. Buy quality, be patient, keep costs low, do not try to time the market, stay invested for the long term, avoid big mistakes. Those principles are as valid today as they ever were. What has changed is the specific implementation. The 60-40 allocation was one implementation that worked beautifully for 40 years. Now we need a different implementation suited for different conditions, but the underlying principles remain the same. I am optimistic about the future. I have always been optimistic about America and American businesses. The next 40 years will bring challenges, but they will also bring enormous opportunities. New companies will be created. New technologies will transform industries. Wealth will be created for those who invest wisely. The key is to be positioned to participate in that wealth creation while managing the risks of a more challenging environment. That requires letting go of rules that no longer work and embracing approaches better suited to current conditions. It requires humility to admit that the past may not repeat, and it requires the discipline to stick with sound principles even when conditions are uncertain. I believe you can do it. The investors who are thoughtful, disciplined, and adaptable will thrive in the coming decades, just as they have in past decades. The rules may change, but the rewards of good investing remain. Take what I have told you today and apply it to your own situation. Think carefully about whether your current approach makes sense. Make the changes that need to be made, and then be patient. Good investing is not about getting rich quick. It is about getting rich slowly and surely, compounding over decades, avoiding big mistakes, and ending up with enough to live comfortably and leave something for those you love. That is the goal. Not following rules for their own sake, not beating benchmarks, not impressing anyone, just building the financial security that allows you to live the life you want to live. The 40-year-old rule is done, but your investing journey is not. Adapt, persist, and prosper. That is what successful investors do. That is what you will do. Remember what I have always said. The stock market is a device for transferring money from the impatient to the patient. The same is true of all investing. Those who are patient, who stick with sound principles, who adapt when necessary but do not overreact, who keep their costs low and their expectations realistic, those are the investors who will succeed. The 60-40 rule made patience easy because it worked. Now, patience requires more effort because the environment is harder, but the rewards of patience are just as great, perhaps greater, because those who lack patience will make more mistakes in a challenging environment, creating opportunities for those who remain disciplined. Be one of the disciplined ones. Let go of the rule that no longer serves you. Embrace an approach that is right for this moment in history, and stay the course for the long term. That is my advice. I hope it serves you well in the decades ahead. Now let me share some specific examples from history that illustrate why blindly following any rule can be dangerous, and why the ability to adapt is so important. In the late 1960s, there was a group of stocks called the Nifty 50. These were the 50 most popular stocks in America. Companies like Polaroid, Xerox, IBM, Coca-Cola, Johnson & Johnson. The conventional wisdom was that these stocks were so dominant, so well managed, so certain to grow, that you could buy them at any price and hold them forever. It was called the one decision stock concept. You made one decision to buy and you never had to think about it again. This was a rule that everyone followed. It seemed to work beautifully. The Nifty 50 stocks kept going up. Investors who owned them felt like geniuses. Financial advisors who recommended them looked brilliant. The rule appeared foolproof. Then the 1973 to 1974 bear market hit. The Nifty 50 stocks collapsed. Polaroid fell over 90%. Xerox fell over 70%. Many of the stocks that were supposedly safe forever lost 60, 70, 80% of their value. Investors who followed the one decision rule lost fortunes. The rule that seemed perfect turned out to be a trap. Why did the rule fail? Because it ignored valuation. The Nifty 50 stocks were trading at 50, 60, 70 times earnings. These were wonderful companies, but they were priced for perfection. When reality fell short of perfection, the prices collapsed. The rule said buy and hold these stocks forever, but the rule did not account for the danger of paying too much, no matter how good the company. The same thing happened with the dot-com bubble in 1999 and 2000. The rule then was that internet stocks would transform the world and you had to own them regardless of price. Companies with no earnings, sometimes no revenue, were valued at billions of dollars. The rule said buyanything.com and hold it forever because the internet was the future. That rule failed spectacularly. When the bubble burst, the NASDAQ fell almost 80%. Stocks that were valued at billions became worthless. Investors who followed the rule lost everything. Again, the rule ignored valuation and ignored the reality that even transformative technologies can be terribly overpriced. The 60-40 rule was a better rule than the Nifty 50 rule or the dot-com rule because it was based on diversification and asset allocation, not speculation on individual stocks. But it was still a rule that worked under specific conditions and failed when those conditions changed. The lesson is not that rules are bad. The lesson is that rules need to be understood in context and adapted when the context changes. Let me give you another historical example that is particularly relevant to the current discussion about bonds. In the 1940s, bond yields were very low because the Federal Reserve was keeping interest rates low to help finance World War II. Investors who bought long-term bonds in the 40s suffered decades of poor returns as inflation rose and interest rates increased. The bond market decline from the late 40s to the early 80s was one of the worst investment periods in history for fixed income investors. Now, I am not predicting that we will have another 40-year bear market in bonds, but I am pointing out that bond markets can go through very long periods of poor returns, and we may be at the beginning of such a period. The 40 years from 1980 to 2020 were unusually good for bonds. The 40 years before that, from 1940 to 1980, were unusually bad. History does not repeat exactly, but it rhymes. And right now, the rhyme suggests caution on long-duration bonds. Another example worth considering is Japan. In the late 1980s, Japan was the economic wonder of the world. Japanese stocks and real estate reached incredible valuations. The Imperial Palace in Tokyo was supposedly worth more than all the real estate in California. Japanese investors believed their market would rise forever. Then the bubble burst. Japanese stocks fell over 80% from their peak. More than 30 years later, the Japanese stock market has still not recovered to its 1989 highs in nominal terms. Think about that. 35 years and counting without recovering the previous high. Investors who bought at the peak and held, following the buy and hold rule, have lost money for 3.5 decades. The lesson from Japan is that valuation matters enormously for long-term returns, and that markets can stay depressed for far longer than anyone imagines. The buy and hold rule works wonderfully when you buy at reasonable valuations. It can be devastating when you buy at bubble valuations. This is why I always emphasize valuation when I invest. I want to buy good businesses at reasonable prices, not just good businesses at any price. The price you pay determines your return. Pay too much, and even a great business can be a terrible investment. The current U.S. stock market is not as extreme as Japan in 1989 or the Nifty 50 in 1972 or the dot-com bubble in 2000, but it is not cheap either. Price to earnings ratios are above historical averages. The Shiller-Cape ratio, which smooths earnings over 10 years, is in the top decile of historical valuations. This does not mean the market will crash tomorrow, but it does mean that expected returns from current prices are likely lower than historical averages. This reinforces the need to be realistic about future returns when planning for retirement. If you are counting on 10% annual returns, because that is what the market has delivered historically, you may be disappointed. Returns from high starting valuations tend to be lower than returns from low starting valuations. Plan for 6 or 7% instead of 10%, and you will have a more robust retirement plan. Let me also share some thoughts on the emotional side of investing, because emotions often cause more damage than bad analysis. Two emotions in particular get investors into trouble: fear and greed. Greed makes you buy things that are overpriced because you do not want to miss out on further gains. Fear makes you sell things that are cheap because you cannot stand watching them fall further. Both emotions lead you to do exactly the wrong thing at exactly the wrong time. The greedy buy at the top and the fearful sell at the bottom. This is why most individual investors earn returns far below the returns of the markets they invest in. They buy after markets have gone up and sell after markets have gone down. They would be better off doing nothing. The 60-40 rule was partly popular because it provided emotional comfort. You did not have to think. You did not have to make decisions. You just followed the rule and ignored the emotions. That had value. But the rule also created complacency. People stopped thinking about whether it still made sense. They just kept following it even when conditions changed. A better approach is to develop the emotional discipline to stick with your strategy through good times and bad, while also maintaining the intellectual flexibility to adapt the strategy when conditions genuinely change. This is hard. It requires distinguishing between short-term noise that should be ignored and genuine changes that require adaptation. It requires the humility to admit when you are wrong. It requires the courage to act when action is needed. I will not pretend this is easy. After 70 years of investing, I still find it challenging sometimes. But it is what separates good investors from poor investors. The good ones manage both their emotions and their analysis. The poor ones let emotions drive their decisions, and analysis becomes rationalization. Develop the discipline to be calm when markets are turbulent. Develop the flexibility to adapt when the world changes. And develop the wisdom to know when to be patient and when to act. These qualities matter more than any specific rule or allocation. Let me close with one final thought. Investing is ultimately about supporting businesses that create value for society. When you own stocks, you are owning pieces of businesses that employ people, serve customers, solve problems, and make the world better in countless small and large ways. That ownership is a privilege and a responsibility. The goal of investing is not just to make money, though that matters. The goal is to allocate capital to its most productive uses, to support the businesses that are making the world better, to participate in the economic growth that improves living standards for everyone. When you invest well, you benefit and society benefits. That is the magic of capitalism. So as you think about your investments, as you adapt to changing conditions, as you let go of rules that no longer work and embrace new approaches, remember the bigger picture. You are not just managing a portfolio, you are participating in the grand enterprise of economic progress. That is something to be proud of. The 40-year-old rules served us well. Now we write a new chapter. Make it a good one.